Well, hi everyone, and welcome to this week's edition of Feeling Smarter. Today, I get to punch Tim because he's right next to me. G'day, Tim. How are you?
I'm going very well, Aaron. How are you doing?
Very well, thank you. Well, last week we looked at 2026 and the year ahead, and front and centre of that is, of course, Division 296 tax. We are going through a period of consultation at the moment, and that consultation closes this week.
Yep.
And we've had a number of discussions, not only internally, but across a number of stakeholders within the industry as well. So today on this topic, I thought we would start by just identifying some of these key points as they will relate to SMSFs. And then over the next few weeks, we'll naturally start to deep dive into some of these areas as well. So, Tim, from initial reading and then the ongoing discussions that we've had and we've had obviously amongst various stakeholders, what are some of the things that pricked your interest when it came to the revised Division 296 tax measures?
Yeah, look, there's a few, and I won't go into all the sort of intricacy elements of it, but I think probably the couple of the key issues for me, with both of us being involved right from the initial release of the original piece of legislation, is one of the early piece of commentary from Treasury was we are no longer legislating towards two separate parts of the industry,
True.
small funds and APRA funds. Subsequent to that, they've only legislated towards two parts of the industry, the gnarly rules.
Yes.
And so Div 296, which was largely problematic in our eyes because they wanted a singular approach,
Yep.
they've now approached it with a dual approach. So with things such as the allocation of earnings, which is a key part of the measure that we want to change, they will have a different approach for self-managed super funds or small funds comparative to APRA funds. And right or wrong, I think that's a recognition that different funds report in different ways.
It's probably a question for another day, but it does raise the interesting point here that for a long time we've been running superannuation legislation that kind of tries to capture all, where super funds are very different. And therefore, from a regulatory point of view and how closely held relationships like SMSF trustees have versus RSE trustees need to be looked at very differently, and whether this is something that we might see a bit more common going into the future. I digress, but I think it's something that is worth just flagging. It'll be of interest to see what transpires. The other thing that stands out for me with these regulations is that it's become a very accounting science-based way in doing things. We've moved from just kind of looking at TSB movements, which was kind of part of the simplification, to really drilling down on the accounting function at a fund level and then looking at it at an attribution level to those in-scope members.
Yeah, and again, one of the key things that we wanted from a change point of view was that was this removal of unrealised gains from the earnings, and we've got that right. Yep. Now that produces some remarkably different Div 296 outcomes for individuals. Certainly, in some instances, it will result in smaller tax on an incremental basis, and then large tax in a single event. And the key to that was always going to be about liquidity. And, you sell down the assets, therefore you've got the liquidity to be able to fund the liability.
And I mean, we've modelled examples where that outcome, the total liability is going to be more under version 2 than it was into version 1. But as you rightly said, the biggest issue is that during years 1 through to year of sale, or prior to the year of sale, you didn't have the cash flow in some instances to deal with it. Whereas post disposal, you've now got the proceeds, just that you might actually have to cough up a little bit more.
Yeah, that's it. And so I think when we look at it legislatively, right, if we take emotions and all those sorts of things out of it, it is a far better constructed piece of legislation than we previously had. Are there flaws? Undoubtedly, right? And there's certainly issues, and one of the glaring issues for us is that there was a previous exclusion for death, which seems to have been removed from this legislation. Now, again, we're in consultation. We're not in final legislation
Yep.
time. So will that be something that changes? Who knows? But that clearly is a shift in position
Yep.
from a tax collection point of view as to who will be liable for the tax. Previously stating, if you passed away, there's no DIB 296. Now it's sort of saying if you passed away, there is still DIB 296 subject to your balance. So I think there's a couple of key things there to be mindful of. But yeah, I think it's an area, and through the consultation stuff that we've done so far, that people are picking up on little things that we perhaps need to have clarified by Treasury with regards to how certain things will work. And the concept of with capital gains tax, for example, whether there'll be dual reporting requirements or a singular reporting alignment with regards to, and we don't like to use the words reset, CGT reset, because it's not a
CGT adjustment in essence.
Yeah. So it's not a CGT reset for the funds point of view. It's something more to do with the growth portion from introduction. And of course, that is the other key thing, isn't it? We're now seeing the introduction from the 1st of July 2026 as opposed to the 1st of July 2025. So we've got that deferral, but it also, we're now in January. So again, time is of the essence.
Yeah. So the thing that stands out to me with this is we have 3 phases to this new legislation. Okay, so we have a phase where we have to consider a whole range of decisions between now and 1 July 2026. We then have the introduction of these measures, and we have some transitional relief that is available during year 1 and some decisions that you effectively need to make between 1 July 26 and 30 June 2027. And then we have, in essence, the full operation of these laws once we hit 1 July 2027. So the nuances of each of those stages is crucial in the work that you're going to be doing with your clients, and therefore understanding, do you make the adjustment because the adjustment needs to be made on all assets, not just on a singular asset? What you might do between looking at TSB or valuations, TSB value, which is a new concept. The difference between the transitional, where it's an end of the year, versus the fact that it's going to be both a higher of start or end of the year calculation. There's a whole myriad of stuff that we need to get our head around, and therefore once we understand some of those fundamentals, we then start to peel layers off to this about things like, well, what's the difference between, say, reversionary and non-reversionary beneficiaries, and a whole range of those things, which we were contemplating under that previous version of this. Noting again that there will be some changes to the way in which this is all going to operate once we see the law actually finalised.
Indeed.
Well, that probably takes us to enough for this session. As I said, Tim, for us, we'll start to unpack this a bit more over the next few weeks. We do naturally have our upcoming State of SMSF 2026 address, so we'll be sharing some key insights into not only what we see in this DIV 296 category, but also what we see across a whole range of factors throughout the calendar year ahead. And of course, all roads then lead to our upcoming SMSF days between 17 March and 31st of March. And numbers, fair to say, have been very, very strong, well ahead of where we were expecting we might be. We might have, I think we've already upgraded a couple of rooms along the way as well. So again, if you want to find out more about not only our DIV 296 topic, which is going to be a core part of our SMSF days, but a whole range of topics impacting the SMSF sector, I encourage you to register. Current early bird, smartersmsf.com/SMSF day. Good catch up.
Always.
We'll see you next week. Bye for now.
Bye.